At yesterday's meeting, the Bank of England were split 5-4 on cutting interest rates by 0.25%. On the one hand, the economy is slowing, unemployment ticking up, spare capacity rising. On the other hand, inflation is proving more stubborn than past predictions. It makes the UK something of an international outlier. The Eurozone has reduced inflation to 2%. Only the US has inflation above 2%, and then the US have a self-inflicted tariff impact. For much of the 2010s, the UK had negative real interest rates, which means interest rates less than the inflation rate. Bad news for savers. But in the last year, the UK had the biggest gap between nominal interest rates and inflation since 2007. But you can see that the recent uptick in inflation is leaving the Bank of England again facing the prospect of getting close to negative interest rates. No wonder there were grim warnings about limited scope for future interest rate cuts. It again leaves the UK something of an international outlier, with UK interest rates higher than most other advanced economies. And of course, if President Trump gets his way, US interest rates will be slashed soon. It does raise the uncomfortable question of why inflation has been persistently higher in the UK than other European countries like France and Germany. The bank have long been predicting a spike in inflation that will dissipate, but this spike has proved more long-lasting than expected. The Deputy Governor remarked this week, "The nature of the persistence of inflation has surprised me." Usually, with slowing economic growth, we would expect inflation to be muted too, but there are several factors pushing up UK inflation. Firstly, there are cyclical factors such as higher food prices, with items like coffee and chocolate surging in price. The biggest driver of food inflation in the UK has actually been rise in meat prices, with deadweight beef prices rising 40%, an effect of falling UK cattle numbers. The post-Brexit trade arrangements have also not helped with food costs. Also, of course, there has been a large increase in utility bills, energy and water, which are responsible for nearly 50% of the excess inflation. But the problem is that as inflation persists, the bank fear it could lead to a self-reinforcing cycle of rising inflation expectations. In particular, workers seek higher wages, and relatively strong wage growth has been a factor behind the service sector inflation. Secondly, government fiscal policy has also worked against reducing inflation. The rising national insurance contributions for firms has mostly been passed on to consumers, with industries with many low-paid workers, like bars and supermarkets, passing on higher costs in the form of higher prices. And of course, if you include housing costs, CPIH is even higher at 4.1%, and even this doesn't include the full cost of renting, which has increased by more than inflation in recent years. Now, an interesting question is that, given the economic difficulties, what can monetary policy actually do to solve the twin conflicting problems of inflation and low growth? The only way higher interest rates reduce inflation is by slowing demand and slowing economic growth even more. Higher interest rates makes borrowers worse off, reducing investment and leaving households with mortgages less disposable income. And so by reducing demand, there's more slack in the economy, and this creates downward pressure on wages and prices. But when the economy already has slack and a weakening labour market, this approach of high interest rates very much has diminishing returns, plus of course all the unwelcome side effects of lower growth, higher unemployment. In short, if the problem is the supply side of the economy, you can't fix it by reducing demand. Equally, if you forsook the inflation target as something misleading and not worth bothering about, what would be the effect of cutting interest rates to, say, European levels of around 2%? Well, certainly households with mortgages would be better off and would probably increase their spending. And the high spending and growth could even start to crowd in investment, perhaps encourage more home building. So in theory, a growing economy is more likely to see investment and productivity growth, which is what the economy really needs. But there are also problems with cutting interest rates. Firstly, the impact would be somewhat limited. In the 1990s, 40% of homeowners had a mortgage, nearly all variable mortgages, so changing interest rates had a big effect on the economy. Now, fewer households have a mortgage, and those who do are more likely to have a fixed rate. So cutting interest rates would only have a small belated effect on influencing a relatively small number of households. Also, lower interest rates would lead to lower saving returns of a growing number of households who own property outright and live on saving incomes. In recent years, the UK has actually seen large growth in the savings ratio, partly as a result of an ageing population or people more likely to save, but also partly about pessimism about the economy, expectations of future tax rises. You better save money now to pay more next year. But the point is that cutting interest rates may be good for firms borrowing for investment and those households with variable mortgages, but it will also make those net savers worse off. So there's no a direct transmission mechanism to suddenly having strong economic growth like maybe in the past. But again, the much bigger picture is that the fundamental weakness of the UK economy cannot be boiled down to just insufficient demand. Even though growth has been pretty weak at just over 1%, the OBR model only a very modest output gap of 0.5%, which means a very small amount of excess supply. And this negative output gap will soon evaporate. So even if you did boost demand in the economy, you will soon run into supply constraints, which is when you start to get demand-pull inflation in addition to all the cost-push inflation factors we already have. And this harks back to why the economy has become very difficult to manage, both from monetary and fiscal policy. If productivity averages only 0.5% for a long time, and if anything has slowed down even more since COVID, it's very hard to get any increase in real wages or economic growth without causing some inflationary pressures. So the Bank of England basically have a deteriorating trade-off, and it's very hard to deal with either problems at the same time. Low productivity growth is also, of course, why the government have a seeming never end to fiscal black holes. Latest one, a forecast of £50 billion to fill in the autumn budget. Because, of course, low growth means lower tax revenue and higher demand for government spending. So what's going on? Well, the bank are concerned about weakness in labour supply, with growing numbers not working due to long-term sickness and disability. And again, this is something where the UK is a bit of an international outlier, with the UK alone seeing a rise in activity rates in the past 5 years. And this rise is costing the economy in lost productivity, also, of course, a rising welfare bill. But getting people back to work is really not as simple as switching a monetary lever like changing interest rates. It needs a whole raft of policies and sticks and carrots, and we haven't got time to go and do it now. But of course, the deterioration in public finances is another long-term challenge for the UK economy, with the government seemingly stuck in a sort of kind of a doom loop of worsening fiscal outlook, requiring higher taxes, but then higher taxes creating the weak growth and contributing to some of the inflation as well. Now, of course, there are alternatives to just putting up taxes. You could cut spending or borrow more, but all three policies have pretty big trade-offs. There's no easy way out there. In the long term, a big problem has been low levels of investment. The UK has consistently bounced along the lowest rate for the G7. Low investment reflects low confidence. And certainly the best way to improve investment would be a period of strong, stable growth and stability in policy too. Firms really want to invest when demand is rising too. And you could make a case that lower interest rates and higher growth may encourage the investment we need. But also, of course, inflation itself can be a disincentive to invest. So the big question remains how to break this cycle of low growth. Labour market reforms to incentivise increased participation, planning reform to encourage housing investment, cutting regulation and tariffs on export to Europe are policies which theoretically could help with higher growth without requiring higher government spending. 2025 is certainly one of the most challenging economic situations. If you went back to, say, 1992, it looked pretty grim. UK in deep recession, unemployment 3 million, house prices crashing. But then the government devalued the pound, left the ERM, and let interest rates fall. And the economy did recover quite sharply, leading to a long period of economic growth. It was a time when the Chancellor could make a big difference with monetary policy. But in 2025, a big devaluation and in cutting interest rates just wouldn't have the same effect because of a weakness in labour supply. So unfortunately, a bit of a tricky wicket, so to speak, and not much positive news today. We're out of time. But anyway, maybe next week will be something brighter to talk about. Thanks for watching. Do consider subscribing, and see you next week.